We have a survey that we do every couple months, thanks to Bill Deuchler, who's a trustee at a pension here in Florida, and also has been when he was wearing his CIO role. If I just get your attention, Bill, we met Stephen Burke. Excuse me, guys. We met him when you invited us to see Henry Kissinger. We have to either shut those doors or pull them in. So Kissinger spoke, and a few days later, we all got together and did a debrief. And Bill put some slides together. I mean, who does that? Bill does. So I was like, Bill, next time we had an opportunity. By the way, we did the coronavirus updates. We did 6 of them, led by Bill. And I think we might have to do another one called viruses updates. But with that, we thank you to everybody who participated in the survey. I think there's some really interesting results. And over to you. Sure. You have the clicker?
I do have the clicker.
Beautiful.
And it looks like hopefully it'll work. Anyway, super to see everybody. For those of you joining us from Naples, it's great. Welcome to Florida. I've been here for 27 years, so it's good and it's getting better. A huge thank you to everybody who filled out the survey for this go around. We had more response than we've had in a long time, and it really helps because there's some interesting things that have showed up on this set of results than previously. So we don't have as much time as I normally have, so I'll have to go even faster, but we'll run through. I think, overall, relative to survey 17, which was last year and pre-election, the overall difference has been a shift from pessimism to optimism. And you can see here, we asked folks like, well, now that Trump is well, I should have changed that slide. Anyway, now that he's actually the president, more optimistic or pessimistic. With regard to markets, still on the optimistic side. With this latest data set, it came in a couple of points, not that much. So you see the down arrows there. But in terms of regulatory environment, the economy, and the geopolitical situations, the overall sentiment improved as opposed to being more pessimistic last time around. So I'm going to jump through a couple of slides here. We always ask, like, what scares you? And I'm going to zip through this relatively quickly. Look for the big font words here. And so in terms of overall, like, what scares you? What do you perceive as your biggest risk factor? And you're seeing commonality in things of geopolitics, inflation. We've actually talked a little bit about liquidity. And number 8. Okay, so what are people going to do about the things that they're concerned about? The plan is to lower your allocation to international, lower to China, maybe even bonds, probably looking at how the yield curve has shifted. Let me go back. Okay, in terms of specifically, what types of activities are people thinking about to hedge those biggest risk factors? And it was a pretty wide range of responses. Overall, building cash was a pretty big one. Energy was showing up, diversification, of course, and then some interesting things with regard to PE secondaries. I wouldn't have necessarily thought that would be hedging out, but certainly if you can get liquidity there, that'll help. People just staying out of various sectors of real estate, and then being more selective and conservative about their underwriting. And finally, gold showed up. We've been asking about gold for several years, and gold has showed up as being a potential asset class for people to get into. So let me go back and, all right. So that's the negative side. How about the positive side? It's interesting. Go back one more. Trump shows up on what scares you. Oops. Uh-oh. There we go. And Trump shows up on what excites you. So evenly split, so you can take your pick. But energy transition, despite the rumblings from the current administration, is still showing up as being an area of interest. And anything that has to do with building out productivity. So you can almost use that as a proxy for AI. And we're going to skip ahead to slide 9. Okay, so public, here we go. Yeah, changes in what are people thinking about as far as specific changes. Overall, we've seen a much more increase in people just interesting flat out changing their portfolios than we did from the previous data set. Now it's a slight majority. And there's a lot of interesting things. Obviously, tech, renewables, and infrastructure is a big one, but even like small and mid-sized banks trying to get into that on the private credit side. And then more real estate, energy, and a true 5-year exit plan. So very disciplined from family offices to think about that. Go on. Okay, we talked about that slide. All right, so then with regard to public versus private markets, where are people interested, particularly for this year? You can see that tech and energy figured very prominently in terms of the responses, but a very wide range of responses that were there. Crypto, which previously has been a pretty big font size, has scaled down, but still there, and a lot of emphasis on high ROIC type of investments. And then on the private credit side, or I'm sorry, private market side, private credit was just huge in terms of the number of responses. And that has been consistent for a while now. Infrastructure also showing up. In terms of what ideas do you want to explore this year? So we were kind of trying to narrow it down. Specifically, what might be high on the list? You can see crypto, biotech. So one of the previous presentations on that. Early stage VC has also shown up prominently. And looks like Todd has left, but certainly you can catch Todd about that. I can talk to you a bit more about early stage VC as at the pension fund. We're beginning to get into it. I'm actually advising a firm in that space as well. It's a lot of very fascinating things coming along. I thought one of the responses that was difficult for the word cloud to capture was energy providers for AI and data centers. That showed up a number of places from various people, but I couldn't condense it down so much to be captured by this slide. Okay, so let's take a look at inflation. We didn't ask about this, but nonetheless, inflation has certainly continued to moderate. I think one of the interesting things is that the higher frequency data is now beginning to point to inflation hovering in at around 3%, maybe a little bit more. And what's really driving the CPI number, as opposed to what you might be feeling when you go to the store or have to go out and buy stuff, it's really the housing component, which is 45% of the CPI. And you can see it is the highest number out here in terms of December and also in months past. But that's over 4%, just over 4%. So if Trump is talking about trying to bring inflation down, really at the end of the day, as far as a CPI number, he's going to have to be able to do something about housing, which is a tough nut. Everybody else is probably feeling everything besides that. So in terms of the perception of the Main Street person that's out there, as opposed to what the Fed's looking at, it's kind of different. And you can see that all the other factors are well below 3%, with the one exception of other goods.
Bill, what if I told you have 1 minute?
Okay.
How would you adjust your life?
It's like so hard to do this. Anyway.
Okay, you got 3 minutes. Just
okay. We're gonna so inflation and recession, two of the big things. The other thing that Trump has been hitting hard on is trying to get the Federal Reserve to cut rates. So why would the Federal Reserve, outside of political pressure, potentially cut rates? There's some interesting things going on very much in the macro space as far as global money supply has been really coming in quite a bit. It's still positive in terms of its rate of growth, but it's slowing down considerably, which if you take money supply out of the system, that is tightening. And you have to have X amount of money supply in order for GDP growth to continue. If you're bringing it in, it's going to be hard. The other thing, yeah, here we go. So here's the U.S. In terms of money growth. This is the dollar value of the world money supply. What you can't see from this chart is the fact that outside the U.S., everything is shrinking faster, not the least of which because of the strength of the dollar. So these are really big macro factors that could push us more towards a recession than not, might give the Fed some ammo to be able to non-politically cut rates a little bit more. We'll see. Anyway, recession expectations for 2025. The numbers really didn't change that much. Solidly no for the U.S., solidly no for Southeast Asia. The others more mixed. Japan certainly no as well. And S&P is showing green lights here in this column for the expectations for GDP going forward. Doesn't look like much of a recession. And okay, we also asked, what do you think about stocks and bonds for 2025? The interesting thing about this data set is that it was in the last one 14%. You can see for the S&P now people are predicting 9% in aggregate. And the range expanded tremendously from plus 25 to minus 28. The aggregate bonds, I think they're pretty much right on at 5%, because that's where the coupon is right about now. So we'll see what happens. Different valuations, I think, Chair Powell. Anyway, there's a lot more to talk about, but I did promise everybody.
You know what we should do, Bill?
Yes.
Why don't we do, maybe tomorrow, we should do, like, give you the proper hour to do this, not the 15 minutes.
That would be great.
Yeah, wouldn't it?
Because I'd love to engage. I'd love to engage
And
more.
so everybody knows, every Tuesday at 11 o'clock, Stephen Berg. Tomorrow at the Satai Hotel and the beach, we have a private room. But you can come by Zoom. We usually have a deep dive. We've never done a deep dive on the survey.
No. So, and to explore that, to unpack, to get your feedback real time would be terrific.
I'm not sure we'll be tomorrow, but we'll be one of these Tuesdays. But now you literally have 1 minute.
That's right.
What's the key takeaway?
Well, key takeaway, I promised expected returns and risk. This is what it looks like. Very similar to where we were last year with it. However, hedge funds has moved up slightly in terms of the exit. And I'm sourcing this from about 7 different sources of expected returns, so it's an average. But still, private credit and private equity are basically the only asset classes above 7%. So this is long run, 10-year projection for the median manager. And let me just, oops, did we get stuck? We got stuck. All right. Anyway, ask me for the slides, happy to do it. The one slide that I wanted to finish on was showing you the spread in terms of various managers across these asset classes. Just to give you an indication, for public markets, it's relatively compressed. For private markets, it's very wide. Specifically for private equity, that spread is 30 percentage points. So if you don't get, everybody knows this, if you don't get the top managers, you're going to be lucky if you even get that data point. So anyway, that's the survey. Thank you so much. Great to see you all again.
Thank you, Bill.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.